I wanted to share with you a quick way to think about refinancing because there's a lot of people asking me whether or not they should try to wait a little bit longer before they refinance because they think interest rates might continue to fall and they don't want to do it too early. Well, let me help you understand the concept of break even and how it comes into play when it comes to refinancing. So every refinance that you do is going to have some sort of cost, whether it's just a cost of time. Maybe there's no closing costs at all, or maybe there's a little bit of closing costs or a lot of closing costs. And that basically is something that you have to take into account with respect to how long it's going to take you to break even on that cost. So for example, if you had a refinance that cost $2,300 in closing costs and certainly a little bit of your time, and maybe you'll save $191 a month on that refinance if you did execute it today. Um, it's going to take about 12 months to break even on that initial investment of that $2,300. And so you have to just consider whether or not that 12 months is a good, period of time to be, worth taking the risk of refinancing now. And I can tell you the way I've looked at it over my 23 years is generally if it's less than 2 years of a break even point, then it's a pretty good determination to go forward with a refinance. And of course, this is 100% up to you. And certainly, if you believe interest rates are definitely going to fall farther, certainly you'd want a shorter break even point. Right now, we're seeing break even points between a year and a half. When we are doing our refinance analysis with clients, we're picking a strike rate and we're setting up a monitor to monitor for that strike rate. When it hits, we know we're at that break even point that we all agreed on was a reasonable amount of time to wait. Now, if you do refinance early, for example, and you've got a 12-month break-even point, and you need to refinance again, and because interest rates fell through the floor, and maybe it was another opportunity to refinance and get that same kind of savings. What you have to think about is you're just basically adding the cost, the unrealized savings, which means the remainder of those months to the next refinance. So you're not making a bad decision. You're just taking it a little bit longer for the second refinance to break even because you have to add some of the cost from that first to the second. So if the second one is 9 months and you have to add 3 more months from the first break even that you never realized, then you're back to 12 months for a break even. Still not a bad decision if perhaps that's the bottom of the interest rate market and forevermore, in the rest of the life of the loan, you're not going to see lower interest rates. You've made a decent decision as well. So try to think about it that way when you're considering refinancing, when you should refinance and pull the trigger, and if in fact you hit your strike rate. If you haven't picked a strike rate yet, and if you have purchased a home in the last several years where interest rates might have been higher than after COVID there, just reach out to me. I'll help you pick out a strike rate. We'll set up a monitor for you and we'll call you when it's time. Any other questions, you know where to reach me. Have a great week, and I hope this helps.